What's up everyone, it's Scotty with MoneyVest. So in this video, wanted to talk a little bit about the Beige Book, which somehow got overlooked in all the chaos with inflation, unemployment, and everything that was coming out. So it came out on September 6th, and it actually had a very specific paragraph on consumer spending. And I looked up the keyword savings, and it caught my interest that I wanted to share with you guys and what some of the districts within the Beige Book, what are they noticing? And I also looked at some of the other reports that are going to be quite interesting. It kind of plays well with the other video that I posted earlier today and why it is a wrecking ball heading our way. And if you are not aware, if you don't prepare for it, of course, it's going to be not that great. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. The 16% annual discount available is till the end of this month, so you can take advantage of that. Of course, get access to all the buy and sell alerts, options alerts, trade ideas, members only private videos, and of course intrinsic value spreadsheets, and everything is going to be included as well. So links are going to be down below. So this right here is the Beige Book. And this was released on September 6th, 2023, so earlier this month. And this basically is a compilation of the Federal Reserve banks all over the US. And this report is released about 8 times a year, which basically goes over a lot of different things, right? GDP, interest rates, inflation expectations, employment. I mean, they're basically connecting with businesses, individuals, their contacts, and putting together a summary of the commentary of current economic conditions, right? That's really what this report suggests and goes over. So when it comes to savings, and this was a national summary, right? Overall economic activity more on a national scale. And this is, again, as of September, earlier this month. They mentioned that retail spending continued to slow, especially on non-essential items. Some districts highlighted reports suggesting that consumers may have exhausted their savings and are relying more on borrowing to support spending. Okay, that is a very, very important topic of conversation because we know that during the pandemic, we had a lot of fiscal stimulus pumped into the economy. And of course, savings rate jumped from, low 3s and low 4s to a high of about 32-33%. It then dropped a little bit and then once again increased substantially as we had that second round of stimulus pumped into the economy. So a couple times we had the savings rate spike to over 30-25%. And the cumulative savings during that time were north of $2 trillion. And I'll go over some of the charts here, which I think are going to be very interesting for us to look at. But over $2 trillion in excess savings were sitting right in the bank accounts for consumers. Now, of course, a lot of that went towards rent and food, and of course, inflation was higher. But that's the point, right? Because of higher inflation and because of the higher consumer spending and the retail sales that have been coming out of the last 12, 16, 18 months, we are now starting to see the consumers exhaust their savings and are relying more and more heavily on borrowing. In other words, credit card. And I'll go over some data. Again, this is not things that I'm making up. This is all backed by data and statistics that I'm going to go over in this video. And I also talked about it very briefly in my other video, but this was from Kansas City. So Federal Reserve Bank of Kansas City, Summary of Economic Activity. And they also mentioned line by line, consumer spending continued to expand at a moderate pace, but with the robust leisure travel offsetting somewhat tepid retail sales growth, several contacts suggested consumers have exhausted their savings. Not may have exhausted, not could have exhausted, or might have exhausted. They have exhausted their savings and are relying more on borrowing to support spending. This right here under consumer spending, it says, in several states, retail spending declined, with contacts suggesting consumers have exhausted their savings and are relying more on borrowing to support spending. Again, line by line, pretty much mentioned 3 times in that report, same exact thing, that consumers have exhausted their savings and are relying more and more on borrowing to support spending. So that is not great news. Why? Because, and there was another report in August, consumers have spent all of their excess savings from the pandemic. That's just one reason why stocks are poised to fall. This was JP Morgan. But I'm not going to go over the stock market more specifically. I want to talk about the savings and the spending rate, and our estimates to excess savings for U.S. households when adjusting for inflation is now fully exhausted from 2021 high of $2.1 trillion, with the risk of widening imbalance if outlays continue to accelerate. So if people continue to spend more money, and of course if outlays continue to increase, which is to say spending is increasing and excess savings have depleted, then people will have to delve into the sort of retirement accounts, portfolio cash accounts, cash liquidity accounts that they already have. And they mentioned that while there are still elevated levels of household liquidity across cash assets, estimated at $1.4 trillion when adjusted for inflation, that too is at risk of fully getting depleted by May of 2024. So now people are going to start dipping into their cash liquidated assets such as stocks, bonds, other cash, money market funds, whatever it is. But excess cash savings are almost over, according to both the Beige Book and this report, suggesting with this chart going over that the accumulated excess savings were a little bit over $2.1 trillion with the drawdowns in excess savings of 1.9 trillion. So we are almost at a break-even point, to a point where we're now starting to be net negative on this excess savings slash the amount of spending and the outlays that we have seen. Now, the problem is that as savings are going down and there's only two ways people can now fund their growth, right? There's only two ways they can come up with the money. There's actually three ways, right? So if I basically go over very quickly, what are the three ways they can fund their growth in spending? Number one is that they make more money, right? Which is the best solution. They make more money and they save more, right? So if people are making more money and they're saving more money, so the savings rate, which right now is sitting at a really low level, and it's declined over the last, 3 quarters, which I'll go over in just a minute. But as savings rate has continued to come down, that means people are saving less money. But the number one way to solve this problem is to make more money and save more, right? So that we get that savings rate back higher and we get excess savings, we get more cash, and people are starting to spend once again. That's number one. Number two is to start borrowing, right? To start tapping into the credit cards, right? Start swiping, start using debt, start using credit cards to continue to spend money and fund their lifestyle and fund and support growth and spending. That's number two. That obviously is not the best solution because you're basically borrowing money, and outlays are going to continue to be higher and excess savings have depleted. So that's not a great solution. And of course, interest rates, we know where they are with credit cards, over 20-25%. The third solution is a solution that mentioned $1.4 trillion in liquidated cash savings and of course cash liquidated assets, which could be stocks, bonds. And if people start selling those to use that capital, use that money to start spending, well, that's going to create some selling pressure and of course could result in the markets pulling back. So those are the three main ways people right now can come up with capital, can come up with money, right? The first way, very, very difficult, right? It's going to be incredibly challenging to increase your income, while at the same time lowering increasing your savings rate and lowering your spending. That requires a lot of sacrifice. That requires a lot of behavioral change, which I don't believe is going to happen. The latter, maybe not so much either, because again, stocks, bonds, when you are invested in them, lots of them are retirement accounts. You're not allowed to touch them. 401ks, you're not allowed to take money out. And at the same time, people may not want to sacrifice that at the expense of spending their short-term needs, right? The only option, which obviously people are opting into right now, is the use of credit card. And that's one of the reasons why credit card debt is also increasing substantially, right? So if you go over to some of the stats here, the total household debt reaches over $17 trillion. This again is from August of 2023, and credit card debt exceeds over $1 trillion, right? And if you take a look at the annual change and the quarter over quarter change for some of these different levels of debt, mortgage debt obviously increasing $627 billion. Now, these are also pretty significant products. Like, in other words, every single mortgage is going to be roughly around, $300, $400, $500,000. So the change is definitely not as impressive. In other words, $627 billion, yes, it's a big change, but not for mortgage debt, right? Mortgage debt is pretty high levels of debt, so it's not really that impressive. What is impressive, though, is look at what the second biggest increase year over year is in terms of these levels of debt. Credit card. Credit card debt is up $144 billion, the second highest increase. Even home equity line of credit is not that much. Student debt is actually lower, and I'm going to get to that in just a minute. Student debt, which is about to resume very soon here, that's going to put even more pressure on the wallets and the pockets of consumers. Auto debt, $80 billion, other debt, $57 billion. But this right here, $144 billion increase in year over year to over $1 trillion. And not to mention quarter over quarter, which is the highest, $45 billion in the second quarter of 2023. That's the highest we've seen among all categories, is also alarming. while all at the same time the delinquency rates are on the rise for credit cards. And this is exactly what I shared in my other video, and the savings rate obviously is coming down even further. So that's the situation, folks, that I wanted to go over very quickly, which obviously does not bode well for where we are potentially headed from an economic standpoint. Now, this is not a doom and gloom type scenario or situation, but it is something to keep in mind, because if you do start to see spending, pull back and credit card delinquencies start to go up, well, then guess what? This can this can ripple into levels of unemployment. This can ripple into a recessionary environment where we are starting to see already a shift in spending with respect to essential versus non-essential items. And what you will notice, again, if you go back to the Beige Book, what was the first line? The first line mentioned that retail spending continued to slow, especially on non-essential items, right? Non-essential items meaning things that you don't really need, right? So people are already starting to shift their spending away from essential, from non-essential to essential items, right? That's what they're really spending money on. In other words, they're spending money on their needs as opposed to their wants. So that behavioral shift already tells you a little bit about where the consumer savings are, right? They are at a very, very low level, and they are focusing more on necessities. That is something to pay attention to. And of course, if that trend continues to play out, that's going to eventually show up in the earnings, in the unemployment numbers, and eventually in the economic growth as well. But let me know in the comment section down below, what do you think? And all of that I'm discussing right now is going to create what? Buying opportunities, right? That's what it's going to create. It's going to create buying opportunities for us, for investors who are ready, who have the cash, who have excess savings, right? So that's why I want you guys to be prepared, have some dry powder ready, and of course, create a watch list, create a shopping list with the fair values where you are going to be ready to take advantage of these opportunities. And of course, dollar cost average into these names that you actually believe, companies that are going to potentially be long-term very, very successful. So hope you guys enjoyed this video. Let me know in the comments section down below, what do you think? As always, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.